Good evening and a warm welcome to all. We sincerely apologize for the delay in starting the webinar due to some technical issues. I am Ridul Mishra on behalf of Care Ratings. Welcome you to our today's webinar on Indian life insurance and sincerely appreciate your time in joining us for this webinar. Our speakers for today is Mr. Sanjay Agarwal, Senior Director at Care Ratings. Along with them, we have Mr. Gaurav Dixit, Associate Director at Care Ratings, based out of our Delhi office, and Saurabh Bhalerao, Associate Director at Mumbai office again. Please be informed that we'll be having a Q&A session no sooner the presentation ends. In case of any queries, please request it to key in the questions. Now, may I request Mr. Sanjay to begin the proceedings, please?
Yeah, thank you, Mridul, and good afternoon to all of you. The Indian insurance sector has been growing substantially over the past few years. To provide a context, over a decade, the global industry grew at a CAGR of about 2%, while the Indian market grew at a CAGR of close to 12%. That's almost 6 times the growth. India accounts for approximately 2% of the global premium volume. The Indian insurance industry's growth has been driven by product innovations and customization, along with development of strong distribution channels. The gap between India's insurance density and penetration level and the average for Asian economies indicates that there is substantial growth opportunity. Life insurance continues to dominate domestic insurance premium. Globally, share of life in total premium was approximately 50%, while the same for India was around 75%. COVID affected the entire economy, but life insurance companies suffered on two counts, mainly loss of sales and outgo in terms of claim settlement. However, a silver lining is that the consumers have realized the importance of insurance. CARE expects the domestic industry to grow driven by pension products, life cover products, supportive regulations, effective distribution, and improving customer services. In the webinar today, we would provide an overview of the industry along with demand drivers, challenges, distribution channels, and indicators such as insurance penetration and density. Outlook and rating perspectives would also be discussed. Now handing over to Saurabh to continue with the presentation.
Thank you, Sanjay. Moving on to the next slide. We would be discussing the overview. The next slide. Looking at the overview growth trajectory of the Indian insurance segment. Since the industry was open to private sector in 2001, it has witnessed several changes, both regulatory as well as structural, and has undergone significant transformation. Moving on to the next slide. India's total life insurance premium reached over 5 lakh crores in FY19 from around 1.5 lakh crores in FY7, growing at a CAGR of around more than 10% due to rising household savings, income levels, increasing education awareness, rise of the middle class, tax benefits, product innovations, and effective leverage of multiple distribution channels such as bank assurance. This growth can actually be broken down into three phases. In the first phase, post-liberalization, all companies witnessed significant traction, especially the private sector, which obviously started off with a very low base. In the second phase, which has been broken down to FY10 to 14, private insurers faced large impact of regulatory changes. On the basis of total individual premiums, LIC, that is the public sector, witnessed a significant growing trend, while private players witnessed a declining share. Due to the bulk of decline happened during the years of major regulatory changes, which necessitated significant effort on the part of the insurers to adapt. Several products, such as ULIPs, were rendered ineligible or had to be substantially modified, and the insurance players redesigned them to comply with the new regulations, resulting in a sharp decline in the number of product offerings. Post that, we have again entered the growth phase. After that, if you'll notice, private players have grown at a substantially larger pace as compared to the public sector players due to the rise of the distribution channels of private players. LIC's individual first year premium registered growth around 3% compared to a growth of CAGR of higher double digits In this can be reflected in the market share also. Market share of private players has increased substantially as compared to the previous players. We can see that over 85% of the premium is non-linked, while the balance is linked premium. Non-linked premium is dominated by LIC, while the private sector holds a large share in the linked premium to their ULIP products. This shift in the premium market share can be attributed to several structural and regulatory changes. The private players underwent significant transformation, leading to increased penetration, higher coverage, multiple channels such as bank assurance, brokering, direct corporate agency, superior reach, and intensifying competitiveness in the market. The overall industry has also witnessed trends such as increased digital presence, emergence of insurtech for innovations around customer education and service products, technology, delivery systems for access. Moving on, when we compare the life insurance growth versus the GDP growth slides, we can see that the insurance premium volume is positively correlated with economic growth and visibly grows at a multiple of GDP and in line with GDP. You can see historically the life insurance premium has grown at over 2 times the GDP growth, but has narrowed the growth differential due to the increased growth and enlarged base to around 1.4 times. This is actually the total premium, not just the first year premium. Moving on to the next slide, where we compare new business vis-a-vis the renewals, we can see that the renewals account for approximately 2/3 of the total premium. We can see that new business premium, when in the earlier part of the chart, has a roughly equal premium, where we can see around 80,000 crores is renewal premium and 76,000 is new business premium due to newer sections of the population being covered by under insurance and rising to around 50, where now 58% is new renewal premium vis-a-vis new business premium is around, this is the balance 42%. This has actually gone, if you see the chart, this has actually gone down from 65% in FY15, where renewal premium was substantially higher. This also coincides with our earlier discussion on the regulatory changes, which coincided during the year FY14, around FY14. Now moving on, we can see that the domestic life insurance continues to dominate domestic insurance company at around 75%, although this has declined from the high of 80, 86, 87, 88% in the earlier part of the decade and gone down to 75%. When we compare this to the global scenario, we can see, on which is presented on the next slide, we can see that the global has also witnessed a decline, but its share is roughly 60 to 50% historically, indicating that globally the revenue or the premiums from life insurance and non-life insurance are roughly equal, indicating that the other segments have substantial catching up to do in India. Now moving on, if you look at the life insurance penetration and density reflected in India, we can see that the density, that is the insurance premium represented in dollar terms, has grown from $40.4 to $58 in FY19, indicative that the premium or the premium paid per capita has increased despite a declining rupee. Now we can see that additionally, the life insurance penetration has gone down from earlier 4% to 2.6% early in FY14 when all the regulatory changes occurred, and has started on a recovery path again, going up to 2.74 in FY18 and 2.82 in FY19. This actually is the insurance density as we compare to the next on the next slide with the global players, with the world average, as well as the other developed and Asian countries, is low. We can see that the world average is around $50, around $75 to $100, vis-a-vis where India is very small at around $55, $58. This actually is much significantly lower than the UK, as well as Japan and France, that is the other developed nations. But if you'll notice, the world average of penetration is around 3.33%, which is not much higher than India's penetration showed 2.82%. Although India has a substantial way to go up before it even reaches the world average, let alone the other developed countries, both these slides actually indicate the substantial development potential within the Indian insurance industry. Moving on to the next slide, where we show new business by volume, that is number of lives that policies covered. We can see the distribution channels. Marketing of insurance services is critical and complex due to the periodicity, claims, and brand switching costs that affect buying behavior. Consequently, distribution is one of the key determinants of success for insurance companies. A variety of distribution channels are currently used to sell insurance products. These channels can be broadly classified into internet-led channels, company-led channels, and bank-led channels and agent-led channels. There has been a shift in the channel mix from the earlier agency-focused channel to a more diversified distribution mix. The contribution of the, as can be seen in the chart, contribution of the agency channel to the new business volume decreased from 40% in FY10 to 11% in FY19. On the other hand, the bank channel in the new business has gone up from 2% in the same period to 18%, while direct channel has increased from 45% to 55% in the same channel. Now, this is actually an amalgamation of all the players, both direct business as well as individual business and group business. We should be aware that group business is actually directly sourced by the company, which is reflected in the direct selling channels. Another interesting facet to be observed is the small 2% share of other channels, which are primarily the online channels. Currently, it is quite small, but given its recent emergence, but it has still been able to notch up a 2% share in the volume and is expected to grow further as in the years ahead. Now, after comparing by distribution channels by volume, on the next slide, we compare distribution channels by value, that is the new business premium. Here, although similar trend holds true, we can see as in the terms of premium, the individual agent channel, we can see had a much higher share of 61% FY10, which has also gone down to 29% in FY19. While share of premium derived from banks has gone up from nearly doubled from 8% to 15%. Also, the one of the highlights has been the 26% growth of direct selling to rising to 52%. This is indicative that the new channels have been leveraged significantly by the insurance companies to drive to drive additional business. Further, the cap on ULIP charges introduced in FY10 led to a rationalization of own network and introduced a shift towards third-party channels. The well-developed banking sector in India and the nationwide presence of banks resulted in an increase of bank assurance contribution to total revenue business. The operational and technological changes have led to the development of multiple business channels in the insurance industry. Due to the rising commissions in traditional channels, insurance companies have developed additional alternate channels to drive growth at lower cost. This has led to the emergence of additional channels such as call centers, mobiles, internet, web aggregators, internet marketing, insurance marketing firms, and websites of insurance companies themselves, which are not tied to single channel insurance company but can sell multiple policies of multiple insurance companies. Although these channels, as has been witnessed in these slides, agency, direct and bank assurance channels continue to remain the dominant distribution channels of the life insurance companies and are expected to contribute substantially going forward. Now, since this is a mix of both group business as well as individual business, the next slide actually splits into two slides. This slide actually shows the distribution channels for individuals and highlights the major share of the individual agents, which is a high touch business, as can be seen from a 78% share in FY14 to 62% in FY19. In the same period, the bank assurance has grown from 16% to 27%. Apropos, this can be said that LIC generated around over 90% of its business, individual new business premium through the agency channel, while the share of agency channel was close to 30% for the private sector. The proportion of individual new business premiums sourced through agency channel has remained at high of over 90% for the last decade, indicated significant reliance on these distribution channels while the share of agency channel for the private sector has reduced from high of 66% to a low of 30% in FY19. Now, although bank assurance has played a significant role, we can also see the impact of direct selling as well as other channels rising over here. Now, when we move on to the next slide, which depicts the group distribution channels for the group business by the new business, we can see that there is a clear dominance of the direct selling channel. That is the which throughout the years, which has remained over 90% and has albeit declined marginally from close to 94% in 14, close to 91% in FY19. This indicates that the life insurers in-house company teams are responsible for these sales rather than any third party or other own tied agency channels. However, it can be seen when we compare the rate that corporate agent banks are also emerging as a channel for these types, which have risen to around 4.2% for the group business. Now, this scenario has actually been pre-COVID when we've been seeing high, significant growth. Now, when we move on to the next slide, we can see that new business performance in FY21. Moving on, we can see that historically there was significant growth in the year-on-year new business premium growth. But when we look at the year-to-date numbers, there has been a negative growth for the year ended November. The numbers released just a couple of days ago. Now, we can see, although another point that is to be cleared, that has to be made clear, is that if we compare year-on-year numbers for the November ended period, we can see that there is a slight dip. But when we compare to the FY19 period, November 18 to November 20, there has been a substantial growth over the 2-year period. The last year was an outlier when a number of policies were closed, which generated significant outflow in these policies. Now, if you notice that single premium policies that is primarily investment oriented accounted for a significant portion of the policies sold in November, but declined as compared to year-on-year levels. However, non-single policies witnessed a significant sharper fall. The life insurance sector reverted to negative growth for the first year premium in only November after 4 months of positive growth. Moving on, when we compare the premium new business performance of private versus LIC by premium, we can see that as the market share goes, LIC has been able to hold on to its market share significantly. But it should be noticed that first year premium for LIC has been growing at a substantial lower pace as compared to the private players. Now, the increase in market share of private companies has been more in the insurance premium, that is value, as compared to the number of policies sold annually, that is volume, where LIC continues to remain the clear leader. Now, next slide would show, as we've been discussing, the new business performance between individual as well as group. Here, a clear picture emerges that in the earlier part of the period under review, individuals accounted for a substantial portion of the new business premium. Studying the chart, it can be observed that the group insurance share rose with a corresponding rise in the share of the direct selling channel. Individuals as well as group company premiums dropped sharply in November, vis-a-vis the positive growth witnessed in November 19. On the other hand, growth turned negative for November group premiums, but individual premiums reported muted growth in November of the current year. The group premium continues to be larger than the individual premium, but individual premium has reduced its gap. If you'll notice this, last year, for the same period, it was marginally higher than the current period. Now, if we compare the next slide, where single versus non-single by premium, we can see that the share of single premium policies has been steadily increasing over the period and has reversed the earlier position where the non-single premium accounted for the larger share. Majority of the single premium policies are accounted for by LIC. On the next slide shows that sum assured has been growing on a year-on-year basis. However, due to the pandemic, the sum assured has dipped in the current year. In sum assured, the reverse is true, where private sector companies have a significantly larger share of around 85% due to their focus on premium pure protection plans and a strong digital presence. On the next slide, if we compare the sum assured segment for the individual vis-a-vis group, we can observe that the rates shares have held broadly steady and has been driven by the rising interest in term plans. Although the business in force in India, when we compare, and the protection gap in India compared to globally is significantly lower, indicating that within India, there is significant opportunity for life insurance still persists despite the strong growth witnessed in the earlier periods. Moving on, the next slide, which shows the digital and the distribution channel. In the current premium, we've always earlier spoken where digital meant the individuals, companies' in-house distribution channels or online efforts or online aggregators, such as revamping the company's own websites for driving business sales or online aggregators or internet marketing firms, etc. What the pandemic has done has also caused the insurance companies to fast track digital options for other channels to drive sales and enable other channels to remain competitive and drive business. The companies have worked on automating and digitizing the insurance workflows across channels to drive benefits. For example, we can see that LIC launched Ananda, online sales platform for their own individual agents. When we look at the drivers and the challenges that the insurance segment, life insurance segment witnesses, which we've depicted on the next slide, we can see that the demand drivers have been, as mentioned earlier, have been income levels, which have, that is, the per capita income has increased perceptibly over the period. Although current year has witnessed some dip due to the lockdown, enhanced income tax benefits, product innovations, and customizations, entry of private players, where for a long time the insurance was earlier, although this is over 2 decades ago, the insurance players are still entering and adopting different strategies. Entry of multiple distribution channels such as bank assurance, rising financial literacy, bundling of offerings, competitive pricing, adoption of technology and alliances. Some of the challenges include a major challenge witnessed in the current year is the economic slowdown due to the COVID-19 pandemic has resulted in challenges, lower sales as businesses were closed and are recovering quite slowly. The other challenges include the low persistency measures. The persistency ratio, as all of us know, measures how long customers stay with their policies and is important as the high ratio not only contributes to the profitability but also helps in reducing costs through economies of scale for the insurance companies. Domestically, this low ratio is currently quite low as when we compare to the international standards, but is generally improving, albeit slowly, both at the 13th month period and the 61st month levels. Domestically, globally, the persistency level is around 90% in the 13th month and over 65% after 5 years. That is the 61st month. In India, the persistency ratios are quite low on both accounts. The another challenge is the low income of individual agents. The average premium per income per policy grew at a CAGR of around 6% over the last decade, even when the average premium income per policy of corporate agents grew at a CAGR of roughly double, that is 11% of the same period. The average premium policy income per policy of corporate agents was 2.5 times, highlighting this divide. The other is high claims ratio. It indicates huge significant benefits being paid out over a shorter period of time. Frauds, which result in both higher claims, higher settlements, lower underwriting profits, and consequential higher premiums on everybody concerned. These challenges are being addressed to improve the vibrancy and the industry growth, as well as increase insurance penetration and density. I now hand over the presentation to Gaurav, who would now continue with the discussion on ratings.
Thank you, Saurabh, and good evening, everyone. Moving on to the next slide, please. The CARES issuer rating for insurance companies is basically an opinion on a life or a non-life insurance company's business and financial strength, and measures its ability to honor policyholders' obligations and debt payments, if any, as per the contractual commitments. The opinion about the policyholder's obligation is not specific to any insurance policy or contract. The credit risk assessment begins by analyzing the various risks, which include management, industry, business, and financial risk. The nature of insurance regulation and the competitive position of the companies are also examined in detail. Care then applies the Ramel's framework to assess the strength of the insurance company. And while assigning a rating, no single factor is considered in isolation, but all the factors, which include risk underwritten, asset quality, management strength, earnings profile, liquidity, and solvency, are viewed in conjunction. While analyzing an insurance company, Care focuses upon analyzing key ratios with respect to these factors, which we shall see in the subsequent slides. Now moving on to discuss all these factors in detail. Next slide, please. Moving on to risk underwritten. Now, analysis of risk underwritten constitutes a key element in the risk rating assessment and plays a vital role in the outcome of the rating assigned. The efficacy of a firm's underwriting strength is brought out by its historical claims experience, degree of diversification in risk underwritten, and the relative growth in the business volumes. We also evaluate the mix of tariffed and non-tariffed businesses, proportion of long-tail business, as well as exposure to lumpy risks such as catastrophic covers. Each business segment of the insurer is analyzed in depth with an emphasis on understanding its unique competitive characteristics that would drive future earnings potential or may cause deterioration in its financial strength. Care considers factors such as market share of the company, geographical spread, the diversity of the risk underwritten, its pricing policy, underwriting expertise, competitive advantages, ability to offer innovative products, and its historical claim experience while analyzing the business segments of the insurer. A quantitative and qualitative assessment of the above factors is carried out by analyzing the trends in premium income, reinsurance ceded, claims experience, and expenses incurred on reinsurance business. Apart from these, we also assess the current as well as potential underwriting capacity by analyzing the firm's operating leverage. Care also examines the insurer's reinsurance program, terms of reinsurance, financial strength of reinsurers, and the company's processes employed to monitor, collect, and settle outstanding reinsurance receivables. Now moving on to asset quality. In respect of insurance entities, asset quality assumes a greater dimension as it influences not only the level of income, but also has a direct bearing on the insurer's ability to provide instant liquidity. The insurance entities are susceptible to credit as well as market risk on their asset portfolio, very similar to banks. Care therefore analyzes the quality and diversification of the assets across various classes. As most of the asset deployment decisions are largely guided by certain regulatory constraints, the insurance company's level of adherence to regulatory norms are assessed along with its performance under these guidelines. Care also measures the degree of success of the asset deployment strategy vis-a-vis the stated goals of maintaining a fair degree of liquidity, yield optimization, and capital protection. These parameters are assessed through factors such as portfolio diversification, credit quality of investments, level of non-performing investment and its NP recognition norms, adequacy of provisioning, and liquidity of their investment portfolio. Moving on to the next slide, please. Now, talking about the management quality. Management quality is a very important qualitative aspect which can make a substantial difference to a company's performance. Care looks at the management's goal, mission, philosophy, etc., and reviews the corporate strategy laid down to achieve the stated goals. The team, while assessing the management, undertakes discussions with the key executives of the insurance entity to understand their perspectives on the strategies and the plans designed to counter challenges which the company is expected to face. The experience and depth of the management to tide over periods of crisis is recognized as a favorable attribute. Care also examines the financial strength and track record of the promoters, the degree of group support enjoyed particularly at times of stress, nature of business plans and targets, experience of key executives manning important positions, and the degree of technology orientation. Strong parentage and the group support is viewed favorably and is examined with respect to past proven support and propositions of future support. Coming to earnings. Care's measurement of earnings focuses on the insurance company's ability to efficiently translate its strategies and competitive strengths into growth opportunities and sustainable profit margins. The profitability for these entities is analyzed by assessment of the profitability for the underwriting and investment functions separately. While underwriting profitability is impacted by the level of premium income, the agency commission, staff cost, and the claims experience. Therefore, to gauge the underwriting performance, various ratios such as premium growth, risk retention, loss claims ratio, expense ratio, combined ratio, investment yield, operating ratio, and break-even yield are analyzed in detail. Well, on the performance of investment operations, the investment income is largely a function of investment strategy followed by the company. However, the behavior of the securities market and interest rate movements also influence the returns on the investment portfolio. Therefore, for assessing the overall profitability, CARE analyzes the level and trend of ratios such as net earnings ratio, return on net worth, and return on assets for their past trend, and also compare with the industry peers to assess the overall profitability of the insurer. Next slide, please. Now, coming to the assessment of liquidity. Good liquidity helps an insurance company to meet policyholders' obligations as and when required. An insurer's liquidity depends upon the degree to which it can satisfy its financial obligations by holding cash and investments that are sound, diversified, and liquid, or through strong operating cash flows. A high degree of liquidity enables an insurer to meet the unexpected cash requirements without untimely sale of investments, which may result in substantial realized losses due to temporary market condition, or it may have some tax consequences. Some of the ratios examined for assessing the liquidity of the insurer include liquid assets vis-à-vis technical reserves, liquid assets to current liabilities, and operating cash flows. In addition, while analyzing an insurer's liquidity, the asset liability maturity profile of the insurer is critically examined. CARE also examines the impact of the stress test on the ALM to understand the shock absorbing capacity in the event of an unforeseen loss of confidence, sudden catastrophic losses, or wide fluctuations in the securities market. Now coming to the final parameter, which is solvency. The adequacy of the solvency margins form the foundation for meeting policyholders' obligations. All insurance companies are required to comply with the solvency margin requirement as stipulated by the regulator. CARE further analyzes the impact of changes in key variables on solvency margins to ascertain the strength of the insurer. Apart from the above, CARE ratings also assesses the current as well as potential underwriting capacity through an analysis of a firm's operating leverage. With respect to the reserving policy, CARE examines the claims experience vis-à-vis the reserves created. The shortfall in reserves, if any, would then be compared with the insurer's net worth. Apart from relying on the regulatory guidance on prescribed solvency levels, the capital adequacy of the insurer is also assessed as this addresses the impact of all dimensions of risk in the long term and therefore helps in arriving at a realistic level of risk. Now with this, I'd like to hand over this presentation back to Sanjay, who would continue with the outlook and the way forward.
Yeah, thank you very much, Gaurav. That was a nice way of putting forward our methodology. The outlook for the insurance industry is not just a function of the economic growth, but industry-specific factors such as expansion in insurance penetration, evolution, and change in share of various distribution channels, enabling regulatory movement, also affect the premium growth. After significant growth in year-to-date for FY20, that is the last year, the life insurance business this year has witnessed a fall in the earlier part of the year due to lockdown and business disruption caused by pandemic and the base year impact. CARE expects the life insurance segment to continue to grow in high single digits for the year as compared to double-digit growth witnessed last year. The growth drivers include high demand for retirement products such as pension annuity coming from an aging population and with low availability of government-sponsored social security mechanisms and rising awareness of retirement planning. The prevailing low interest rate scenario would continue to drive performance of guaranteed return plans. The pandemic has created a rise in the demand for protection plans. ULIPs may also witness some interest due to strong market performance. Younger demographic opting for pure protection plans drives insurance coverage. Intense push to increase insurance coverage, especially in the rural populace. Product innovation and customization, channel innovation and customization, rise of multiple channels, and continued tax benefits. Companies are expected to incur significant investments into bundling digital into all the distribution channels while maintaining a razor-sharp focus on cost improvement to sustain the margins. Overall, the outlook is expected to be stable in the medium term. With this, we take a short break and would open the webinar in a couple of minutes for questions. Thank you.
Thank you, sir. Dear audience, we are open to Q&A session now. You can please key in the questions in the slot provided. We'll be taking up the queries in a particular order. Thank you.
Hi, welcome back to the Q&A session. We have a query from Zubin Truset. The question is, how has the movement of product mix been from the time private players were allowed in to sell insurance? Now, as we mentioned earlier, the sector was opened up in 2001 to the private players. In fact, ICICI and HDFC sold their first policies in the year 2000 around November, December. Earlier, and then the product mix had generally tended towards the traditional plans, that is the endowment or money back plans, with uh, limited focus on pure protection plans. Now, as the time has passed, the there has been a rise in both ULIPs as well as protection plans being offered over a period of time. We have another query from Mandeep Mehta. How do you see the sector growth going forward? As we've been mentioned in the webinar earlier, the insurance segment is positively correlated with the GDP growth and grows as a multiple of it, of the same. Now, that does not really mean that if GDP growth dips, grows negative, and insurance becomes negative. What it means that the growth definitely does slow down. We foresee that uh, the life insurance in India will go a high single-digit place with a focus, and as mentioned in the webinar earlier, with a focus on and protection plans. Although ULIPs might or might make a comeback considering the market performance. Another question, which any trends observed abroad that might be replicated in India? Actually, when we see the abroad distribution channel growth or any other agency intermediation is being actually followed within India as well. They are coming into play where we are trying to drive the online or the other intermediate growth. In India, as we mentioned earlier also, there is a significant protection gap. Now, what that actually means is that we actually need to buy much more insurance that we're currently buying. Now, this we need to address, and it is being processed right now in India going forward. There's another query. We just wanted to ask, what is your opinion on the insurtech in the sector? When supported by a conducive ecosystem, insurtech has a significant potential to enhance customer experience, reduce claims, turnaround times, and provide data-driven insights and support both customers as well as insurance companies to make informed decisions. Technology has already improved the traditional value chain via digital distribution and customer experience. For example, some insurance technology-based platforms startups offer on-demand small insurance packages, mobile-powered micro-insurance platforms, and remote claims management capabilities. Insurers have also introduced chatbots for improved customer service and drones to assess claims in agriculture insurance. As can be seen, there is another query: how does India's penetration compare with other BRIC countries? Now, India, as we've shown earlier, India doesn't, with Asian or other European or other countries, similar countries, India's penetration is slightly lower compared to other advanced countries, but lower than the aggregate world aggregate. When we compare to BRICS, when you say density, insurance density, India falls significantly behind the other countries, given the dollar measurement in dollar premium value.
I think that was the last question taken up for the day. There's a query from Mr. Srijit Nair also from Cogensis. Mr. Nair, we would be responding to your queries via email. So that was the last question taken up for the day. And thank you all participants for taking your time out and being a part of this Care Ratings webinar. In case there are any unanswered questions we are still typing, that probably will try to reply individually by email. For any further queries, feedback, or suggestions, you are most welcome to write us in the comment box, which will be coming no sooner the webinar ends. Thank you and goodbye for now.